Hello, my name is Todd and I am an accounting and business tutor at the San Juan College Student Success Center, where success matters. In this video, I am going to discuss the accounting equation and normal balances, which are very important as they comprise the framework that all accounting records use. Once you achieve an understanding of this equation, most accounting transactions will make immediate sense and can be easily journalized. The basic accounting equation is written as assets equal liabilities plus equity, or A equals L plus E. Assets are what a company owns or is owed, such as buildings, inventory, prepaid expenses, or a receivable. Liabilities are what the company owes to its creditors and will be paid from future assets, such as accounts payable, notes payable, or wages payable. And equity is the owner's share of assets minus liabilities, written as E equals A minus L. Equity fluctuates from four causes. Owner investments in cash or other resources kept in an owner's capital account increase equity. Owner withdrawals, usually in cash, decrease equity. Revenues from sales of goods or services increase equity, and expenses, wages, utilities, insurance, etc., decrease equity. Adding equity changes to the basic accounting equation results in the expanded accounting equation. Assets equal liabilities plus owner investments minus owner withdrawals plus revenues minus expenses. As you know, accounting uses debits and credits to record transactions and keep account balances. Debits are always on the left-hand side of a T account, while credits are always on the right-hand side. Although each account uses both debits and credits, each account has what is called a normal balance. If you look at the basic accounting equation as a T account, you would see what the normal balance is for most accounts within each category. Assets have a normal debit balance, while liabilities and equity have a normal credit balance. Most asset accounts have a debit balance, while most liability and equity accounts have a credit balance. I say most because some accounts have opposite normal balances, such as an asset account having a normal credit balance. These are known as contra accounts and are discussed in a separate video. Two accounts making up equity have normal debit balances, owner withdrawals and expenses, and two accounts have normal credit balances, owner capital and revenues. When using T accounts, pluses and minuses are not used. Accounts with a normal debit balance increase the account using debit entries and decrease the account using credit entries. Similarly, accounts with a normal credit balance increase the account using credit entries and decrease the account using debit entries. The difference between the debit's sum and the credit's sum, including the beginning balance, is the account balance. If the debit column is greater, the account has a debit balance. And if the credit column is greater, the account has a credit balance. If the debit and credit columns are equal, the account has a zero balance. When using double entry accounting, every transaction must adhere to the following rules. At least two accounts are involved. The total amount debited must equal the total amount credited, and the accounting equation must remain in balance. If you consistently follow these rules, you will always have balanced entries and keep the accounting equation in balance. In the following examples, each rule is noted and explained. In the January example, customers made payments on their credit card accounts. The cash account increases by $500, while the accounts receivable account decreases by $500. Since both accounts are asset accounts, normally with debit balances, the net change to assets is zero, and the accounting equation remains balanced. In the February example, the company pays employees their wages. The wages payable account, which is a liability account with a normal credit balance, decreases by $1,000, while the cash account, an asset account with a normal debit balance, also decreases by $1,000. Since assets and liabilities both decreased by $1,000, the accounting equation remains balanced. In the March example, the owner contributes equipment to his company. The equipment account, which has a normal debit balance, increases by $5,000, and the owner's capital account, with a normal credit balance, also increases by $5,000. Since both assets and equity increased by the same amount, the accounting equation remains balanced. However, the April example is not a balanced entry, as the total amount debited does not equal the total amount credited. This entry would throw the accounting equation off by $25,000, and so cannot be entered into the accounting records without correction. As you can see, by following the 3 double entry accounting rules for every transaction, the accounting equation will always remain in balance. This concludes the accounting equation video. Please feel free to comment or ask questions in the comments section below the video. You can also ring the bell to receive notifications when new videos are posted. You can subscribe to the Student Success Center YouTube channel, and don't forget to check out and like our Facebook page. You can also request a tutoring session, either face-to-face or online, for additional assistance in learning the accounting equation. All links are in the description below. Thank you for watching.